All right. Hey, good afternoon, everyone. Here we are. It's Monday, 2 o'clock. Let's take a look at what the markets did today. Didn't see a whole lot in the fundamental realm of things. You just saw a lot of volatility across a lot of markets, right? Oil was down, cattle were down, grains were kind of all over the place. We'll take a look at that on some of the shorter term stuff. But big picture, here's corn, right? This is December corn. We've had this up move since the September low. It's been held by a couple of big green bars and then really just a lot of sideways action. We've got this trend channel here that we had a breakout out of on Friday with a failure back below. And then today, what we didn't like is that we closed below the full body here. So we've undone all of the strength that was done last Thursday, and we attacked the low that was made on Thursday as well. Did we break it or not? I don't remember. The low today was 90 and a quarter, and the low from Thursday was 90 and a quarter. So we tied it. What we really don't want to see happen, we don't want to see it break outside of this lower trend channel here and break this 87 and 3/4 level. A move below that, I think, is bearish and puts a bearish count in, which should a minimum attack the 468 level, and will probably move to one of these lower clusters of Fibonacci support. So how do you calculate these? Well, you calculate these Fibonacci numbers using this high, the distance between this low and this high, and the distance between this low and this high is how you calculate these numbers, and that puts us down into a zone somewhere between 440 and 455, potentially even as low as 350 if you go towards these lower levels. So this isn't something that we want to sleep on. I don't think it should do that, but hey, what we think does not matter in this market. What this is telling us is that prices look to be a little bit weak. Now, as far as our hedge line, this is where we're at. Really a critical point. We're still above it, but barely. So we need to get up and out of here, and we can't dally below here at all. Is it possible that we have a false breakout below and then a reversal? Sure, anything's possible, like we did Friday, right? But you can't assume that that's going to happen, so you have to assume that any breakout's going to have follow through. Otherwise, price is down here and you're still hoping for a reversal. So we don't want to be in that camp with the exposure that we've got. So we're going to be really careful to make sure we get our risk managed up here in this 490 level. Okay, let's take a look at wheat. Wheat almost went higher today. It was up, I think, 8 or 10 points at one time. Had a bullish engulfing day, but then ended up closing on the bottom side of its range. I think at this point the odds favor a lower breakout of both corn and bean and wheat, and so we need to be managing risk here below this 663 level or 660, because a violation of these levels and you just don't know where we're gonna drop and find the next level of support. So I don't think they should go lower. I think they should hold, but clearly there's a lot of selling up above. You can see these long upper shadows every time we try to rally. Rally, long shadow, rally, long shadow, rally, long shadow, long shadow, long shadow, long shadow. We just keep selling wheat anytime there's any sign of strength at all. And a lot of times what'll have to happen then is the market's got to relieve that pressure by going into lower prices, and then maybe we'll start getting lower shadows. For instance, in beans, we had a nice long lower shadow for most of the day today in beans, and then it just fell apart right at the end. I'm going to show you the 10-minute chart of soybeans so you can see what beans did, right? We sold off overnight, and then we had a nice rally to start the day. This really looked good. And then all of a sudden we end up just with a down A, B, C, wave 2 up, and boom, a 3-wave move down or a 5-wave move down. So this isn't good structure here at all for what we want to see. So when we look at the daily chart, you have to keep that in context that we accelerated to the downside with kind of wave 3 impulsive fashion. So what could end up happening here is if we don't get a quick up down that reverses, then this low is in jeopardy here, and we may see weakness across the board. We also closed below our hedge line. All those things point to lower prices in our book. So right now, the best risk reward on the bean chart is short below this 1312, 1315 January soybean level. That's the best risk reward on the chart, and you can reevaluate that on a move back higher. There's no guarantees it will go lower. Again, fundamentally, we're bullish. I don't see why this market would fall apart, but it seems to be wanting to do that anyway. So we're going to have to make adjustments that don't make sense with our fundamental analysis, in our opinion. Beans shouldn't get really exuberant to the downside unless we break the lower trend channel. But here's the problem, is that like corn, it's on the bottom end of a trend channel, and that trend channel on soybeans doesn't come into play until 12.48 on January beans, or almost 60 cents below where we're at. So we don't want to wait for that. We'd rather take the risk to the short side up here, and just get with it, because if it does fall and it's a wave 3, it might just look like that. I don't think it will. I don't think that the fundamentals sit out there for that. It's not what we're seeing, but a lot of times markets don't do what we think makes sense. So we're going to be pretty defensive with that coming into tomorrow. Okay, let's look at cattle. Right, this is what maybe we're going to look at cattle. Why won't that chart load? Let me go to a 60 minutes, see if it'll load that. Nope, let's try a different cattle chart then. Let's go. No, it doesn't want to do that either. Okay, let's go to a different chart. There we go. Here's our feeder cattle. Okay, so here's your feeder cattle chart. This is what we're worried about. When you start to see a related commodity like oil or meal or cattle, all these things are kind of interrelated. So when you see a price decompression like this, this is what you don't want to have happen in soybeans either. So if you're watching cattle, we don't trade it. I'm just using this as an example, but the reality is that you're in a nice rally, then you get a break, you think, oh, I want to buy it. Okay, now we get a deeper break. Oh, hey, that's a great deal. So we buy it, and the market lures you in, and then boom, now all of a sudden you're much lower than what you would have been. And if you put in a trend channel from, let's go from this point here up to here, and then you snap right, you should see the similarities to what we're doing here in corn, right? There's your trend channel. Here's the upper boundary. Here's the break of the trend channel, and you ignore it because you assume it might be false and you're going to get a retest to the bottom, and you didn't. And now all of a sudden in cattle, you are you're $21 cheaper than where you should have sold it in the first place. So now look at that chart, and let's put corn back on here. And that's what we're not going to let happen in corn. We're not going to break out of the bottom of this thing and then worry about getting hedged down here. We're going to do it now because we just have too much price risk that's in there. It doesn't mean corn doesn't go higher later, because you can easily come down and back up. But the reality is we don't want to sit through this one, because it may happen too fast, and it's just not the right time of year to maintain that kind of a risk. Okay, oil is another good example of this here too. So oil, I think oil's potentially got problems here. Despite the volatility in the Middle East, oil's off 228 so far today. And why is that? I mean, there's hostilities, right? We're contemplating a war and armed conflict with Iran using our troops, and all of a sudden oil's down. Well, look at it. We've got a 13, we've got a 9, we've got a double top. We've got a lot of bearish formation here on this chart, and it could easily turn around and look just like the cattle chart did. So we got to pay attention, because when these things, if they do move together, then they could all do it in a hurry, even though it may not make sense to us as to why they may do that. But these setups are vulnerable. I can't say it enough times in enough different ways. These things really could accelerate lower from here. This day today was a bigger down day than what we had on Friday. And if we put one other one on tomorrow, that's 3 black crows on soybeans, and boom, you could just unravel this thing kind of like we did here. And like beans like to do several times. There's been a few times when beans are down $2 or $3 in 3 or 5 days. And the first day is not a big deal, second day is a bigger deal, and then all of a sudden, boom, they just collapse. So not trying to freak everybody out, but answer your phones, because if we call and we want to sell stuff, that means that we really want to do it right now, because our risk reward to the downside is here, not from down here at these lower levels. I can't say that any more clearly, I don't think. All right, I hope you guys have a great night. Remember, there is risk trading futures and options, and you should only do so in light of your own financial condition. We'll be actively monitoring this stuff tonight, and be mindful of your texts, be mindful of your phone calls, because we may want to shed some risk pretty quickly in the overnight if we get lower prices. So with that, we'll sign off, and we'll talk to you guys later. Have a great night. Bye.